Good morning, everyone. It's 8:03 a.m. Chicago time, 9:03 Eastern, on Tuesday, the 14th of February, 2017. Happy Valentine's Day. Um, just a quick, subtle reminder. Um, Thanks for joining me for this Trader Bite. Derivatives trading involves substantial risk of loss. It is not suitable for all investors. Past performance is not necessarily indicative of future results. The overall market sentiment today is looking to the downside, slightly mixed. The Russell leading the pack lower this morning, where the S&P 500 is opening right in the middle of yesterday's range at 2324 or so, 25. Leading the pack is crude oil. Crude oil is gapping up. Crude oil has been trading in a ping pong kind of pattern between about 53.75 and 53 quarter, just back and forth, back and forth. I see two high volume nodes there. But other than that, the S&P minis and the NQ, the Dow, and so on are almost unchanged to slightly down. So there's not much going on there. Also, if you looked at the overnight session, you'd see that the market didn't accomplish much at all. The news feed shows that after the market closed yesterday at 5 Central, 6 Eastern, Fed's Kaplan came out. He's from Dallas, a moderate voter. Says the Fed can raise rates in a gradual and patient manner, should act soon to raise rates or risk having to abandon its plan to do so slowly. So that's kind of an interesting take. Also, last night, our current government U.S. Commerce Secretary has stated that the U.S. is considering a new currency strategy to pressure China from devaluing currency to boost exports. And then also this morning we got a slew of numbers, CPI out of Switzerland and the UK. We got some numbers from China, PPI out of the UK. And then the German February Zoo Current Situation Survey came in at 76.4 versus 77, slightly less than expected. The expectations came in a lot less than expected at 10.4 versus 15 expected. And also the PPI final demand in the U.S. came out about a half hour ago, much stronger month on month for January, 0.6% versus 0.3. So that's what we had. What we were expecting to have today is what's left, at least, is just a bunch of speakers. We have Fed's Yellen heading to the Senate banking panel. This should be interesting. 10 Eastern, 9 Central. Fed's Kaplan again at 1 o'clock Eastern speaks in Houston, and at 1:15 we get Fed's Lockhart speaking about the economy in Alabama. So that's what's on deck. Let's have a look at what we expected yesterday. Now, I'll be the first to tell you that I don't have, this is not my favorite kind of market. I don't have any reliable statistical probability type setups to lean against here at new all-time highs. And so to me, it's pretty much reading order flow and looking for areas to lean against in the direction of the trend. For example, yesterday, there was just no reason to get short as far as I was concerned. And that alone, that revelation and bias alone, saves me from having to dig myself out of a hole because I'm fighting the market. So the primary hypothesis yesterday was for the market to open in a gap, go sideways, make an attempt at the prior day's range, which had a high of 23.1575, not close the gap zone, and then continue higher. That is the hypo that worked out. Of course, you look at this and you think, okay, yeah, well, it's going to continue to go higher. What genius! The fact is, it is still a plan. It is still a plan, and the idea is to look at what is around you, what areas could present support or resistance, in the form of not just prices but zones, and then to lean against those areas to initiate a trade in the direction of the prevailing force in the market, whoever happens to be stronger. So yesterday, as I did the pre-recorded session, the market was at 23.1850. It ended up opening at 23.19 something. And it pushed higher right away, and I'll go over this in a minute. But we had some really good hints. The market really spoke out loud at the open. The secondary hypothesis, and this is just a possibility, this is not to be read as it is by some, that, oh, well, you have a prediction that goes up and a prediction that goes down. You have your bases covered, something's going to be right. Well, the exercise here is not to be right. The exercise here is to have to identify what the market might look like and how you'll respond to it. That's all. And so when we look at yesterday, the expectation was for it to push through that overnight high, extend the overnight high through, and then fail to find buyers, and then rotate back into the range, bounce off the range at first right here, and then rotate back into the range, giving us a target of 23.12 and a quarter as an initial target. And then we have a low volume node beneath there, and another high volume node down below that at 23.10, which would be the extended target. That's hypo 2. What actually happened was this. Note how small this is. I mean, I haven't squished the bars that much on a 2-tick Renko, and it's covering a third of my screen, almost a quarter of my screen, the entire day's range. This just says, and this is the reason I use Renkos, this just says that there just weren't that many rotations to work with. Now, when we look at what the market did, we have an open auction. Just as we expected, we left a gap zone below. I'll mark this in the flex levels here as soon as the trader bite's done. We left a gap zone behind. This is really important that it leaves the gap zone behind. If it leaves the gap zone behind, and there's a statistic to this, if it does not close this gap zone within the initial balance period, then there's a really high probability that it's likely to continue to push higher into the later parts of the session. These are days I do not short when we leave a gap zone behind beneath us, and I do not go long when we leave a gap zone above us. This is really important to have that sort of a plan to keep yourself out of being enticed into taking a short in a market that is continuously rising. And so this is the first hint. We're gapping up. The market's unable to turn around and test the prior range, which is the most recent auction, the most recent value, and then makes a poke test here into the opening swing, fails to hold it, makes a new high, and then from there it just goes sideways, bounces around the mid for a couple times, and then you notice the larger rotations are generally positive. So you have a 4.0 rotation positive, -3. The next rotation is 3.75, -2.25, up 2, down 1.75, up 2, down 2.25, and so on. The prevailing rotations are to the positive side. It's another hint, and we get this large rotation upwards, 7.25 points without a single 6-tick pullback, and so we end up pushing all the way up. And here's another little thing. My bookmap resets at the end of the session, and I would have to show you a replay, and I'm not set up to do that right now. But this is an impulsive move by far. This is higher than a second standard deviation rotation, the 7.25 points, and so this sets us up for a pullback trade, for a continuation or at least an attack on that 23.29. And you notice the market just pulled back. We're right to the mid, but it pulls back to the zipper area here. Those of you who have attended my webinars for Big Mike and so on have heard me talk about these zippers, and I use these as an area to initiate on a pullback. You notice the zipper here holds, and it helps this area stay intact and provides an area to lean against. Unfortunately, the market ran out of time here on the close, but under normal circumstances, until it breaches this zipper, which puts us right at the mid, till it breaches that, you're looking to the long side all day yesterday. Again, not my favorite trade. I'm not a fan of solid trend up days. It's just not fun to trade. Um, the overnight session takes us into just what is a completely disinterested market. This market is not at all exploring anything in the overnight session. It's unable to price anything. It's accepting the prior day's value area as fair and has done nothing. The overnight session only traded 115,000, so you can see the volume right there, very small. 115,000 contracts, and has basically done nothing. We have a box profile which says the market is completely imbalanced and has a very tight range. The overnight range is only 4.25 points. That's pretty small. It's well within the norm, but it's below what we would consider to be common. So the overnight session is not giving us any hints. We did not test the prior day's high, which is interesting. So what we have is an impulse pullback and a potential for corrective action. I would love to see a corrective move today. This thing is just trucking along day in, day out, which makes for a very boring trade. Now, none of these days are imbalanced. So this day is not imbalanced. This day is not imbalanced. This day is not imbalanced. We are in a clear, you got to be able to see it. We're in a clear trend up in a channel here. But what I did is I drew this composite just to see where the liquidity pools were that actually traded versus the ones that are offered. And as I build this profile, you can see that the market just keeps building higher, then rotating, like you see here on this day, rotating, shifting the point of control up, building higher, rotating. See how sharp that this high volume node becomes, rotating. So it's pushing and then it's pausing and it's pushing and it's pausing, and that's what we have right now. And it's in a longer term trend type environment, which again into new all-time highs does not bode well for my way of seeing the markets, because I don't have any prior auctions or prior information to play with. So I'm relegated to using targets based on measured moves, which are basically fib extensions. So in these situations, I basically look for what has the prior day done, what are the areas that are being tested, and so on, and look for these targets. The gaps also ruin that idea as well. We have not had a clean pullback to do an extension on so far, so I don't have any measured moves up here. When I pull up the flex levels, this measured move comes all the way from December at 23.30.75. We missed that by about 2 points yesterday. So there's not much for me to work with. As far as the week, the most common close to high, prior week close to this week's high, the most common range from the prior week's close to this week's high, based on 597 weeks. 597 weeks. It's a long time. It's about 11 years. Is 0.5%. 0.5%. That 0.5% mark is right here at 23.24 and we breached that yesterday. So what this is saying is, because we gapped up, the market's already reached its most common range high for the week, and it's showing significant strength here. It's showing significant strength here, and it's continuing higher. So this is creating an environment where the market is taking out the potential week's high in the first day, and it's really, really strong. So I am at this moment, I'm simply looking for hints early on. A day like today is likely to get rotational. We do have some really amazing targets beneath us. We have some gap zones. We have key areas that were never tested, like this 23 1275, which is a point of control, and a closing price. Beneath that, we have a point of control and a closing price at 2304, and so on and so forth. So once this starts to rotate and clean up, and regain some of its sellers, the trade downwards is likely to be very, very interesting. Now, just just to take a pause, a moment of wisdom here. Um, I've been at this for almost 17 years now in the professional environments, always around traders, big and small, starters to, 20-year veterans. And I can tell you that for those who are sitting here going, well, this sucks, I'm going to go do something else, it's very easy to come to the conclusion that this is over, the game is over, and so on. And maybe you'll come to that, maybe you'll move on, and maybe that's what's good for you. But I can tell you that the market moves in cycles, and cycles favor different programs, different approaches, different strategies. And right now, the cycle favors the long-term investor, the swing trader long. That's who it's favoring by far. The market's pricing in massive tax breaks and a lot of promises by the current administration, and still has room to the upside. Don't kid yourself. But markets like this lead to a cycle ending and shifting into a different type of cycle, and it leads us into a cycle that is favorable for short-term traders, for example. We don't know when that's going to happen, but you have to stay engaged in this kind of environment. You have to stay engaged day in, day out. You notice that I'm doing the same process. I'm following the same hypos. I'm doing the same thing day in, day out, because I cannot predict when the next opportunity is going to be, and I have to be here for each one of them in order to take advantage when it happens. This cycle here is not my cycle. In fact, I would love to, tweet out that I'm not doing a trader bite because I have nothing new to say. But the fact is, I'm still doing the homework. I'm still preparing. I'm still updating my research and things like that, and figuring out my probabilities. And coming in every day and doing what I need to do, because I don't know when the change is likely to happen, and it will happen. And so we're in a trend up environment. We've breached the prior week's high. We're one-time framing up. We're continuously one-time framing up, and that's just the environment that we're in. So lay off. Don't hold your shorts too long. Lay off taking too much risk on the short side. If you do, make sure your stop's in place. Other than that, just look for areas to lean against. Like you could see here on my order flow software, you could see that the overnight session, got the bid offer became really heavy here at the 8 o'clock hour. But the overnight session has been very quiet, with a fair amount of bids down here beneath us. Let me remove this arrow. You can see there's a fair amount of being bid as the market drops. You could see that this is starting to light up and get brighter and brighter as the market continues to drop and push towards this. There's just a fair amount of liquidity underneath, and it's that liquidity results in collisions, which means that people will take those sellers. Will get filled on their bid. They want those bids. They want those markets to trade those prices, and it just continues that way. And this is just an important way for me to stay out of trouble. With that being said, I want to remind everyone that I'm talking today at 11 a.m. Eastern. The invitation is in the description of the video, and I'll be talking about how I'm using that order flow a little bit more, and some of the tools that I've developed for it. So anyway, let's look at our hypos. I'm getting distracted. Here we have a market that's opening in range, in value, against a prior day's trend day. This is an open auction probability. I would love to get a push lower to test and clear out the weak longs. We have a fair amount of support down here, which has caused this to be the point of control. I'm looking for a bounce, a corrective move up, and then I'm going to look to push for a new high again. The market seems to be running out of steam just for today after yesterday. But this move, this big move up that happened yesterday, is still incomplete in my book. So the primary hypothesis is going to be upward, but not that it's just upward, but notice what the plan is likely to be. I'm looking for evidence once the market opens for any support down below for me to lean long against that support and then to add on a corrective move. Okay. The secondary hypothesis is always an open auction and the opposite play. The market pushes up immediately, pulls back. Except today, I'm looking for the pullback to be shallow and for the market to continue to push up. The tertiary plan, the third plan of the day, is the sell plan, which I would love to see, as I'm sure many of you do as well. If you're day trading, the tertiary plan is for it to push higher, fail to make a higher high, and then start to move towards the point of control and then retest that low. I would be shooting for that low, and then I'll be looking for the mid of the gap zone underneath here. So the mid of the gap zone is likely to be this area down here at 23.17. That would be the target for Hypo 3. Okay, those are the three main ideas. As I said, just keep your powder dry. The market's not for everyone all the time. And if you switch to scalping, just remember what your real plan is and to fall back on it once the market cycle changes. And then I want to remind you that today at 11 Eastern, I'm going to be speaking on I was invited to speak by Bookmap on their professional trader webinar series. And that's at 11 a.m. The invitation for that is in the description of this video that you're watching, this live stream that you're watching, and it's also on Twitter. Okay. Good luck, guys. Watch your risk. Don't get emotionally involved with the market. Keep your head on straight, and stay true to your plan. Good luck.